that like if some investor want to have a tailor-made financial portfolio, so derivatives can help, but derivatives can also help in hedging and also for speculation equities. Now there are two types of the two main types of derivative security. One is known as forward, another is known as options. These are two building blocks. And then another one, which is also a type of derivative, is called swap, which I will briefly explain to you. Now let us please keep in mind that option will be discussed in the last unit in detail, where I will take up the underlying factors of the option pricing, like Black-Scholes formula for calculation of option. Here I will briefly discuss these aspects. Now, as I said that the derivative securities, they derive their value from some underlying asset. Therefore, one important type of derivative security is forward. Forward, as you can see the word forward. Forward security that obligates one to buy or sell a specified amount of an asset at a specified stated price on a particular date, regardless of the market price at that moment. Very similar to this is a future contract, which I will explain to you what. Like if somebody buys a forward on foreign exchange. Now here the value of this derivative on dollar, let us say rupee dollar, will be derived from the movement of the rupee dollar exchange rate. Right. Now forward, is a mechanism by which those who purchase or sell, they can lock in certain amount of the payment, which will be obligatory on them. For instance, let us take an importer is there. Importer has a payable of 1 million after, let us say, 3 months. 1 million US dollars. Now let us assume that the rupee dollar exchange rate is 70 rupees. Just an example. 75, let us say. And the importer fears that by the time this 3 months becomes due, then the rupee will become 78 rupees. Now what the importer can do, that importer can buy a forward contract of 1 million at a stated price, that let us say 76 rupees per dollar, and for after 3 months. Now what will happen that whatever happens to the exchange rate, so the importer can pay 76 rupees multiplied by 1 million for $1 million in the rupee, and can get that amount and pay the obligations, fulfill the obligations. Now the forward contract is obligatory in the sense that you do not have an option that you can close without exercising it, whereas you'll see later on that in option this is there, that for instance on this day, when after 3 months the exchange rate is, instead of 76 rupees, it is 75. So why will one buy 1 million at 76? So one will let it go and buy from the market at 75 rupee. 1 rupee multiplied by the 1 million, when the amount of the contract is high, so it also entails a higher amount. So, but for exercising that, I explain to you that a price is paid. Now forward contracts are provided by the banks and other according and tailored to the parties which are required, that those who want it, maybe exporter and importer. So it is a kind of contract which drive their value from the underlying, you know, exchange rate, dollar. If a forward is bought on dollar, then naturally the or any currency, so this value will be governed by that. So the payoff will be, for example, rupee depreciates further, it becomes 79, 80 rupees, then naturally the importer will be better off to much larger extent. So, this is forward contract. Whereas futures contracts are very similar to the forward contract. Only difference is they, these are the over the counter. These are, count. There is no specified exchange like a stock exchange. Whereas this type of contract, when it is carried out on a recognized exchange, it is known as future contract. The word futures, you may have heard about oil futures, gold futures, and others. So they are standardized contract. It is here that contract can be tailored according to the need of the party, the exchanging party. But here they are standardized that 1 million US dollar, this and that. So they are contractors and they are regulated by the exchange for futures exchange. So, and in forward contract, what happens is that the whatever contract has been entered into, it has to be carried through. It does not. It means that one cannot pay the difference. That okay, we will not take 1 million and let us pay the difference of whatever it is there, like 76 rupees. So we will pay you the amount which you can get it and then close it. It is not that. Whereas in futures, same feature, it also future contract that provides one to buy or sell a specified amount. Specified here is standardized. The amount is specified at a stated price, a particular date. Only thing is that these transactions are carried out in a future exchanges, like stock exchanges. There are future exchanges as well, where it is bought and sold. And in future contract, what happens that at the time of maturity of that contract, this is just closed without actual delivery. Where it is here actual delivery takes place in forward contract. That is why 99% of the transactions at the future exchanges are speculative. So they offset it. For example, if the exchange rate, is 76, and this is the stated price, exchange rate, and it is 77 now. So what will happen that the difference will be paid to the exchange and will be closed down instead of purchasing the entire amount of 1 million and then taking the delivery. The difference is paid and the contract is closed there. So those who have opted international finance, they will study this thing in some more detail in the forward, futures, and exchange. Especially our focus is on exchange rate, but this is the gist of. Then another type of contract is it is given here. What type of future contracts are prevalent. Like in metals, energy, products, interest rate futures are also there. That if you like same way that the derivatives on interest rate, the companies which have obligation borrowing requirement, they can buy it. Another side also, because in market there are two sides always. The buyer and seller of that. So we find it. And future contracts are usually used to hedge financial risk which is involved, and for arbitrage or portfolio diversification. Anyone can hedge it, using it to minimize the risk. Now, these terminologies will become clear to you when I take up after this the concept of return and risk and the concept of portfolio diversification. Just I'm leaving for the moment, so I'll come back to that. Similar to this type of contract is a, option. Here option also, you know, option gives the holder the right, the right to, just forget this word call, okay, for the moment. This is for the moment, ignore this. An option gives the holder of the option the right to buy, or let me put it like sell, a specified security, for example, stock on an index at a specified price on or before. It means that if you buy a call option on Reliance share, there are two types. It gives the right, but not the obligation. Like, that in futures, the forwards are obligatory, not obligatory. Anyone has got the right, one can exercise this right or not. For example, if the prevailing price is favorable to the buyer or seller, one will not exercise, let it go. So if somebody, and there are two types of options, one is known as call option. Call gives the right to buy, and put option gives the right to sell. Now, if somebody has got a call option that it has got a right to buy Reliance share at certain price. Let us say, I'm just, sharing here of actual price, just giving an example. Let us say 1,000 rupees, 100 shares of Reliance for 3 months, duration is 3 months. So it means that one can buy Reliance share at 1,000 rupees, 100 share, at the end of the 3 months, after 3 months. So there are various types of options like 1 month, 2 months, 3 months, and because exchange rate authorities specify that for this you have to, so maturity period may be like this. Now, why this is done? Because one may have made investment in Reliance stocks, and one may be thinking that we can offset our hedge against the fluctuations. Now, for exercising this, one has to pay a price, which is known as the option premium. This right which is provided, is not free of cost. The price is paid for. Maybe let us say 10 rupee per option. Just an example. It means that if you have bought 1,100 shares, so you have to pay upfront 1,000 rupees. Just an example. So, or let us say 50 rupees. There is a method by which the option premium is calculated for providing this right. Now, one can see that after, so one has logged in and one has got the right. But let us say at the end of the 3 months, the price is in the market is 900, let us say 90. Okay. Rupees 99. So why will one exercise this right to buy 100 shares? One can buy from the market. One is let it go. Without exercising it, the only thing one will lose is the amount of the premium which has been paid. So, here, but whereas in forwards and others, it is obligatory, irrespective at the end of expiry period, you have to exercise, you have to buy this at this price. So option gives the holder the right to buy and sell. Now, it may be other way. For example, I have given the example of call. It may be other way around. Another person who would like to sell it, he fears that the prices may fall. So same thing. So the seller, one has bought put option on this. So if the price is prevailing price, let us say is 1010 rupees. Seller think that the price may fall below this. So if the prevailing price in the market is 1010 rupees, why when one exercises 1000, one can sell at a higher price? So we'll let it go. Only thing one will lose is the option premium which has been paid. Now option has got various terminologies like call option, put option, the exercise price, the price which is like 1000 rupees, the expiration period, the 3 months I have maturity period, the option premium which I just explained to you, and time value of money, intrinsic value of money, and so on and so forth. So all these will be taken, and payoff of options are also there, will be taken up in the fifth unit in detail about that. So this provides a gist of what is an option, which is naturally the value of this option is derived from the movement of the, let us say, stock. It may be index, Nifty, for example. If you bought it, the movement will be, the same thing is explained there, put option. And also, so I have explained you the only thing made the change there and explained to you. So it is written here, investor buy put option hoping that securities price will fall, so they may sell the security at a premium or to protect them from losses in case they also own the stock. For instance, somebody has bought a stock. So one can hedge. For example, all the upside potential will be there. But if his stock price falls, one can buy a put, the right to sell. So whatever, if it falls, so then it may be compensated by this insurance against the fall. So that is why these are also used for hedging and for speculative equities as well. So this is what we call and put option, and naturally option has got various benefits, like the one can benefit from that, not only buying the underlying stock, but one can make huge profit also. But you know that it's very risky. It's got high risk and high return game. And that is why most of the disasters in the financial market are also driven by the derivatives. Very famous investor Warren Buffett called derivatives as weapon of mass destruction. So, but derivatives have got its advantages and uses as well. So, and then one more variety of derivative is, which we call it swap, which is swap. Actually, as I told you, the two building blocks are there, but swap, what happened that swap, the word here you can understand it, to exchange a specific series of cash flow at a future point in time. One famous example of two representative examples of swap are currency swap and interest rate swap. Again, this is a part of international finance, which I have also taught for decades, more than 15 years. Currency swap is that when they, for example, a company has advantage in raising fund in, let us say, in Japanese yen. Another company Y has advantage in raising loan in terms of dollar. Now this company needs a loan in terms of dollar, and this company needs loan in yen. So what they do, that they undertake an agreement where they exchange, swap this flow, this loan arrangement. Now why they do? Because this company has got advantage, maybe it is Japanese, its rating is high in particular market, and therefore the swap arrangement are driven by the competitive advantage. Some companies have competitive advantage in raising fund in a particular type of currency, and any swap arrangement, such type of swapping of at the is takes place only because it is advantageous to both the parties. Otherwise, if this company raises fund in a particular market, it will cost the high, the rate of interest charge will be high, whereas this company has advantage in raising fund in at a lower interest rate. And when this company want to raise in dollar, it may incur high interest rate. So that is why they undertake a swap arrangement where they exchange this and like this. Similarly, the interest rate swap is that in some the loans may be raised based on the fixed rate, interest rate, or it may be based on floating rate. That is, the rate is not fixed, but certain fixed amount rate plus the variation which we normally call LIBOR, London Interbank Offer Rate. So if this fluctuates. So what happens is that again, two parties, entities may be there. One may have an advantage in raising at fixed rate. I would like to raise at floating rate, whereas another want to raise in fixed rate. So both companies undertake a swap arrangement, because this may think that the rate of interest may go down, whereas this may think otherwise. Naturally, when any arrangement takes place, both have different expectations about the movement of exchange rate, and another reason may be there that they can know for sure that how much they are going to pay, because if fluctuating the floating rate is there, then the financial obligation may not be pre-specified, because that may vary. So it depends upon and therefore these two common arrangement of swap are prevalent, where currency swap is taken, and another one is interest rate swap. And in natural finance, we normally take example to illustrate it how this will be done, but this is the crux of these swap arrangements. So these are derivative securities, and the option, as I said, that forwards and forwards and options are the basic building block, and they have got, and that option pricing. How much premium to be charged? For example, when I was explaining to you this part, I told you that a price is charged, a premium is charged. This premium is a price. What price it should be sold? The price option. You know that there was not a formula for calculation of options, and the breakthrough came in 1973 only, when Black and Scholes, Fisher Black and Miron Scholes, and Robert Merton, they developed their famous formula for calculation of the option pricing. Now the same formula is used for all the exchanges also to find out. It has got 5 variables. We will discuss this thing in the last unit, where we'll discuss the valuation of derivatives and how some history also. But this formula is is highly mathematical, but the underlying, how they arrived at that formula. But the final output of that formula involves 5 variables, and this modeling is very complex, because the kind of mathematics which has been used is Ito calculus. Ito was the Japanese. So like the calculus which you have studied is deterministic calculus, but this calculus is stochastic calculus. Because stock prices are not in a deterministic environment. They are the stock prices move in a random fashion. So the kind of tools which were available could not be utilized. So the efforts were on since early 19th century to develop a formula, but breakthrough came in 73 only, and economics of a stature of Paul Samuelson also tried their hand but could not arrive at the formula, and they received the Nobel Prize also in the year 1997. Fisher Black did not receive because he died at the age of 53, and Miron Scholes and Robert Merton received Nobel Prize for their contribution. So this is some brief about the development formula, but I think that when I go to that, I will. Now, so far what I have talked about is the investment, the financial securities, which provides opportunities for direct investment. Okay. But there is a way that one can participate through indirectly. Mutual fund investing is, indirect investment. One can reap the benefit of the investment, benefit of diversification and other things by buying the mutual funds, units of mutual funds. So what I'm going to discuss, first I will briefly tell you about what are the mutual funds, some features, advantages and disadvantages. And then I will discuss about the types of mutual funds, that's brief idea. And I will also briefly apprise you about the exchange traded fund, which is also part of mutual fund. And lastly, I will discuss about the hedge fund, which is different, but they are also a type of fund where the investors' contribution or the investment is managed, but using different type of strategy. Now, mutual funds, in US, the maximum amount of investment is done via mutual fund. Direct investment is not carried out by the retail investors. So, as I have explained to you, a mutual fund holds a portfolio of securities in line with the stated policy and objective. Whenever you are making investment in a mutual fund, the mutual fund specifies that where investment will be made and what and like that. So it's very clear. Like in the first part of my lecture, while talking about the statement of objectives, I told you that the large investors like mutual fund, they have a stated objective. Retail investor may not specify it, but they may have. So let us try to understand it further. Mutual fund is a vehicle of collective investment, like what they do. Let us try to understand a mutual fund. Mutual fund, you can say that it's now investors are here. And these investors, they buy units. Okay. So what the mutual fund do then, and these mutual fund, they make investment on behalf of. Now here, what the mutual fund do that they offer indirect securities, which is called unit. It is not a direct security, like 10 rupee units. So one can make as less as 1,000 rupees. Now what they will pool this. The amount is pooled by the mutual fund, by small investor. Now using this money, they will make investment according to stated objective. That let us say they make investment in 25 security companies based on certain stated objectives. Now here, and the mutual fund hold the security, direct security. When they buy shares of companies, they are holding. Whereas because of the performance of this portfolio, the investors will benefit. It is like that one is entrusting the task of investment to mutual fund, Mutual fund, they make investment on behalf of the savers, those who have put their money, investors, and they benefit. So it is not that in the investors, they are benefiting indirectly, you know. That is why the certificates are not issued of the companies where the mutual fund has made investment in those. Rather, the mutual fund, the itself issues indirect security, financial security, which you call you. So, it's you participate, you become a part owner of the held under scheme. A part owner means that the amount of money which you have made invested, you will become, that is 1,000 1 lakh. So you will become, if the corpus is 50 crore, naturally you will be a part owner of that. And the history of mutual fund is that till 1986 only UTI was there, and now we have more than 30 mutual fund houses offering thousands of schemes which are there. So, and the mutual fund, the price of mutual fund, the value which we arrive at is that is the market value of the fund investment. For example, let us say X company, Y company, just assume that 3 companies are there in the portfolio. Market price of these stocks into number of shares with the mutual fund had bought it. So if you multiply this thing, it will call with the market price. Okay, the market value. So add it, you will have the value of the total. Maybe 30 companies are there. So similarly, so the and plus other receivable and equity. So there is a concept of NAV, net asset value, of likely unit holders. For example, somebody has purchased at 10 rupees. Now, because of the investment timeline, during this timeline, the value, the per unit, and then when the value is this much, let us say 1 lakh units are issued by the mutual fund of 10 rupees. So we will divide the value. That will become, but after certain adjustment like liabilities and other expenses, and it is given here number of shares outstanding or unit outstanding. So in this way, we the NAV is arrived at, the face value is 10 rupee. Naturally, when the investment is providing return more than is the then its value goes over. Some of the units are there which were issued at 10. They are traded at more than 100 rupees or 2. So it depends upon the duration of investment and like that. Now, what are the benefits of mutual fund? Let us briefly understand. One of the benefits of mutual fund is that they provide the benefit of diversification. Another is professional management. They also provide liquidity. They also offer tax advantage. And another important thing is the regulatory body, they have got very strict regulation as far as mutual funds are concerned, and they are very transparent in operation. So let us go one by one and try to understand. I will explain to you without going to those slides, because diversification, you will appreciate when I have discussed this thing, is the benefit of large investment in a small investment. Diversification is the basic adage is, do not put all your eggs in one basket. All your eggs in one basket. What does it mean? It means that you should not make investment in 1 or 2 securities or assets. Rather diversify 15, 20 or 30 lakhs. So now if your portfolio comprises of some 15, 20 or 25, then it will not be the case that all these assets will perform badly. Some may perform well, some may not perform well. In this way, one can reduce risk. And when you can reduce risk, So it will never be the case that all the are performing badly at the same time or like that. So there is a method, like Markowitz, which we'll study after this, is that if securities are not perfectly correlated, there is a chance of risk reduction. Now, for an individual investor, having a diversified portfolio is very difficult. That one can make investment in 15, 20 stocks, 30 stocks portfolio and monitor the performance of these. And you know that one form a portfolio, 30 stocks, something like that. So it's not possible for individual investor, small investor. What the mutual fund provide, that they provide this benefit to small investor because they have made investment in a diversified portfolio, at least consisting of normally 25, 30, 32, because after 30, the benefits, tapers off, there are not much benefit of further making investment. So they make investment. So now this benefit is provided to the investor, which was not available for small investor to hold. And as I said that the headache of monitoring this investment, even if somebody make investment, so one constantly has to keep track of revising, monitoring, revising the portfolio. So all these benefits are provided by professional management. So there are fund managers in mutual funds. Another important thing is about mutual fund is that we'll make a distinction between two types, open-ended and closed-ended later. Is that the mutual fund companies, they are ready to buy back, the whatever, if you want to sell it, you can sell it easily back to them. They are ready to buy it. So it's also a liquid in that sense. One can dispose of. If one want to dispose of the investment, one can be the mutual fund companies, they are ready to buy. So in some cases, they also offer tax advantage. There are some fund, if you make investment, infrastructure and other, one can also get the tax. And another important thing, they cannot be fly-by-night operators, like some swindlers and they come in and they say that we will provide, because there is a comprehensive regulation of the mutual fund. And their portfolio and their operation are very transparent. They have to disclose where they have made investment and like that. So that is why the mutual fund provides benefit of large investment, which is not possible for a small investment. By buying very small amount, one can reap the benefit of large investment and can avail of the services of the professional managers as well. So these are explained in my slide. When I give it to you, you will go through this. Okay, I'm cutting short. But there are certain disadvantages as well. Disadvantages are there when you sell off. There are entry and exit load. Maybe one person does something like if you buy exit load, so they can deduct it 1.5 or 2. So naturally, there are, even in trading also, there are the brokerage costs may be there. And sometimes some people, that you entrust the task of investing to somebody. So some people would like to have a thrill of making investment when they are making investment themselves. So one may not enjoy that thrill of managing one's own portfolio. So this may be, so for those, mutual fund may not be so. They would like to directly. But as I said that for a large number of small investors, which dominate the market, you see that managing such kind of portfolio is not possible. That is why when a country like US, the chunk of investment is done through mutual funds. It is not that people are managing their fund directly. Now, mutual fund can be classified also on the basis of two types of schemes which are there. One is called closed-ended. Closed-ended means that its subscription is open for a certain period, limited period, 1 month or 3 months. Whereas open-ended means there is no end to it. The mutual fund, say XYZ mutual fund, so the units are continuously offered and redeemed. There is no fixed corpus that they will come with the units for a particular period. One can buy, one can offload, sell to the issuing mutual fund. Whereas for this close-ended, it is subscription is open for, and if they want to dispose of, they can dispose of only on a stock exchange. So, like close-ended are traded on a stock exchange. You can dispose of like any stock. The company will not, the mutual fund will not buy. So whereas in open-ended, by and large, we find that hardly few close-ended schemes are there in India. So the majority of the are the open-ended schemes. So so one can buy and sell from the mutual fund. So that is why the end. So this is the difference. Are listed on secondary market, that is stock market. So I have already explained to you. Go through the slides. All things are explained in quite detail. One disadvantage of closed-ended fund is that it is a puzzle in finance that they are traded between, with 5 to 20%. Now, this word I have already explained. It is the market value of units, market value of investment of the mutual fund. Now, what happens that these, when they are traded on stock exchanges, they are traded at discount. For example, if the NAV of is 15 rupees, so below this 20%, it means that maybe the 13 rupees or something like that. So why it is being traded at below this 15 rupees? It should be in the vicinity of that. So it is a puzzle in finance why this happens. Whereas the underlying value of the portfolio of investment is 15 rupees. NAV is known, but they are traded, but no satisfactory explanation has been offered. So it continues to be puzzle in finance. So you can go through all other things. I am leaving. Okay. Some other things are there, but I think that you can easily understand it. Now, various types of mutual fund schemes are like stocks are. Some mutual fund schemes may be based on stocks and equity or equity related investment. Their predominant investment is equity or equity related. And some are fixed income like bond, debt instrument like that, and some cash, any very liquid type, a maturity of less than 1 year. When I use the word cash, treasury bills, commercial paper, certificate of deposit, which are reverse repo, call money, and bank deposit. They are very liquid, short-term money. So based on this various permutation combination of the fund may come in. Like some may be predominantly equity scheme where the investment is in equity or equity related. Some may be diversified equity schemes. The investment is carried out in various companies on the basis principle of diversification. Some may be index scheme where investment is made in Nifty, the stocks which comprise Nifty 50 or BSE. So the same portfolio. So they may be available. So that is why if Nifty is up, the Nifty offered by a particular company will mimic exactly the performance of these index. So they are indices. So they form portfolio based on this. Then there are sectoral schemes, infrastructure, energy, and some thematic also, like value scheme, growth scheme, and other scheme. Nowadays we find that some other scheme like ESG, environmental, and so on. So there are various types of the thematic type the mutual fund schemes are there, and there are some are based on tax planning scheme where the government provides tax concession if you make investment there. So, and some are hybrid type, some 50-50 type, 50 like 50-50 balance funds are there. So 50 in equity, 50 maybe in other equity oriented more than normally 65% are in equity and the rest in debt. Debt are more than 65% in debt, rest 35% in. And variable asset allocation, these schemes, they vary according to the prevailing market conditions and like that. No, even in the equity oriented scheme, some amount money may be sitting in cash in a very liquid, maybe 2%, 3%. So oriented means that they are tilted towards more of that. So all these were given here, investment schemes, and explained in my slide. And also theme, I told you that mid cap, small cap, infrastructure, commodities, multinational services, all these types schemes are there. Plethora of index scheme I have already explained to you, Nifty index and tax planning, hybrid scheme. So I have provided you the main idea. Now, lastly, in mutual fund, there is a type of fund which is exchange traded fund. I have told you that it is a hybrid of closed-ended index and open-ended. You know that in open-ended, the issuing fund is ready to buy and sell the units. In closed-ended, once the subscription period is over, the mutual fund will not offer further units and will not be buy it. You can dispose of. So it is a mix of where these are traded like any other shares in the market, and they are redeemed by the issuing authorities. So it has got various type of exchange ETFs are there which track index like Nifty, commodity or sector or like that, and they trade like a stock on an exchange. It is similar to closed fund exchange. ETFs experience price changes throughout the day as they are bought and sold. Whereas NAV, for example, open-ended, it is not that throughout the day the portfolio may fluctuate, but that it is the declared at the end of the day are like that. But here when you are buying and selling this type of ETF, like any stock, the price of this fund will fluctuate based on the underlying, stocks or securities which are there. So these are some of the differences between these three, that open-ended, closed-ended, exchange-traded fund. So fund size is flexible. It is fixed. Whatever comes in. Exchange-traded is flexible. It will, if somebody is buying, so that will be provided. So as I said, pointed out that it has got both closed-ended and the open-ended features. So the open-ended scheme, the NAV is daily, whereas it's also daily, but in real time, it is changing throughout the day. The liquidity provided is fund itself. Closed-ended stock market you can dispose of. Here the stock market and fund itself. In the stock market also provides this thing, and the fund itself, both. At NAV plus load, if you sale price plus load means that the amount charged, significant premium to discount. As I pointed out, there is a puzzle that they say very close to actual NAV of this scheme when real time trading takes place. Throughout the availability is the fund will provide it through exchange. If you want to buy closed-ended or sell, it will be via exchange. Through exchange, where listed fund where listed fund itself, both in a monthly NAV portfolio disclosure is monthly, and here daily real time, every. So, and one can use the cash for making investment, equitizing cash, may using cash for investment for tracking certain equitizing cash possible. Equitizing cash, you can use for investment, and also hedging and arbitrage. One can use it. For example, one may have made investment in certain, one can use this for further minimizing the risk or for arbitrage if there is a mismatch. Sometimes it happens that the ETF value, that is the exchange, their portfolio value is of ETF, and there is a tracking error that the portfolio of this thing and the underlying securities, there is a mismatch. So what they do that they try to arbitrage, buying the which is lower price and selling the which is overpriced. So this will become clear in the fifth unit in some more detail. And intraday trading here not possible in mutual like, because as I said, it is expensive. If you want to buy a sell close-ended, you can do, but here it is possible at very low cost, like any other trading of stock. So these are some of the features of exchange traded funds, which has also gained currency for in recent times. Now, one type of fund is also there, which we know as funds of funds. As I told you that mutual fund always provides benefit of a diversified investment. But if you are making an investment mutual fund, let us say XYZ mutual fund, making investment in ABC mutual fund. And this mutual fund is making investment in a mutual fund. So this is called fund of fund scheme. So, so it is a step further that investing in stocks, the mutual fund will make investment in other mutual funds. Now, this means somewhat perplexing because you know that mutual fund is already diversified. So what are the benefit of over diversification? So it has also gained currency in recent time that they do it. But there are limits to diversification, that you cannot, even if you buy entire universe of stocks in the global, that you cannot eliminate market risk, which we will study in the third unit. You cannot eliminate that. The macroeconomic factor and other factor will affect each and every. So that is why the fund of fund scheme has also become. So this is explained here. I have already told you about this. You can go through this. Now, lastly, I will just briefly highlight about a hedge fund. Hedge fund, like mutual fund, are vehicle of collective investment. Collective investment where the investors subscribe, buy the units or the securities, and then hedge fund or mutual fund on behalf they make investment in a portfolio. But there are some differences. While mutual fund open is to general public, funds are typically open to wealthy individuals. That not every Tom, Dick and Harry or one making 1,000 rupees can participate in mutual fund. The minimum amount of investment may be 1 million or 10 million, less than. Like Zerodha is operating a hedge fund where the minimum investment is 1 crore, or some other mutual hedge fund which are there. The minimum amount that may be will be in this, and institutional large they make investment. Mutual funds are heavily regulated, whereas hedge funds are lightly regulated. One of the major players in financial crisis in East Asian currency crisis was the George Soros hedge fund. So it's not very regulated. They are very opaque as far as regulations are concerned. And they engage in various types. They use not only their fund, but use debt also, which we call leverage. Taking short selling. You sell something which do not own it, but you think that the price will fall and will replace it. And use derivatives like option, futures, and other kind of products. So they try to make it. Whereas mutual fund cannot. Mutual fund they do not use these type of strategies. So that is why the investment strategy of hedge fund managers are very different from that. Like the Zerodha hedge fund, which I was there, more than 30 to 35% returns provided. It means that in 2 years the amount will double more than. So it means that they are undertake, but they are very risky also. The classic example of failure of hedge fund was long-term capital management fund, which was managed by even Nobel Prize winners. So this collapsed, and the U.S. government bailed out this fund. So hedge fund they are very opaque type of fund, and they because they undertake investment strategies, buying the underprice and like that, and sometimes the selling the overpriced securities and like that, and they have got huge corpus of money, billions and dollars. You know that those the hedge fund manager, their salary is millions, and uh, and so therefore there are some books more money than God. They are managing it, because they wealthy individuals, they subscribe to that, and that is why when they enter a particular market and leave a particular market with a huge corpus of fund, they can make or mar the destiny of nations also. So, and hedge fund managers were the main culprit behind also the financial crisis. They are also known as hedges. You know, so they get huge compensation. That is why the financial sector is highly remunerative in terms of the those who manage their funds. They also reap benefits. Yeah. So this is in brief about the various types of securities and others, and so I will provide you the slides you can go through. In next class, I am going to discuss about the return and risk. First, I will provide you an introduction about what are the various kinds of returns and their calculations, and then we will introduce to the risk and its calculations, the basics, and later on we will take Markowitz. If you have any question, you can ask. Still, there is some time left. Unfortunately, only 17 students are here. Abhishek Wartne, Adit, Aisha Khan, Hamza Mahmood, Muhammad Saad, Munawwir, Muskan, Nafis Hussain, Nahid Rafi, Nidal Ahmad, Rajat Warshne, Mohammad Zahir, Waris, Yash, and Zainab Bilgrami. So these are the students who are interested in only, even the 50% is not. So if you do not have any question, I will close it, and I'll provide you slide for the lectures which I have delivered. Okay. Yes, yes. Identify yourself and put your question.
Yes, I'm Vice Sir, I was asking that how do we know that these are how these funds are, but how do we invest? How do we decide that in which thing, like in which options, or how do we invest in these type of securities?
There are various methods for investing, but some of the basic feature of investing is that one has to look at the return and risk aspect of any security, isn't it? So, for example, if you are looking at equity, how much return and how much risky it is. Okay. For example, options may have provided high return, but they are very risky also. So these features I will introduce next to you. When I start talking about return and risk, the criteria for making investment, how can we form a diversified portfolio, and what criteria should govern on. Okay. So that will be discussed in next lecture and onwards. So you will get an idea about, and once you have got the idea about these the underlying factors that affect the return, then we will discuss about the how can we carry out analysis of for example, a particular company, whether it is worth investing or not, based on the fundamental analysis of like the whether the price at which a stock is sold is overpriced and underpriced. So the second and third unit will prepare you for the fourth unit, where will you really come to grip of the valuation of a security for investment viewpoint. This is just an introduction about the types of financial securities which are there. Whether you make a portfolio based on the equity stock, preferred stock, bond, or even in stock, there are thousands of stocks. So which stock you should make? So uh, second and third unit will provide you foundation for these investment criteria and investment principles which one should keep in view for making investment.
Okay, sir. Thank you.